the common theme that I've seen from the beginning is that if you show any of these folks a term sheet from a competitor that's better than theirs, that will move the needle quicker than anything else. Hello, everybody. This is Jake Stenziano, host of Wheelbarrow Props Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, I am doing good, my friend. We've got a lot of stuff going on in the hopper, don't we? We've got a money mixer coming July 5th for the Jake and Gino members. You guys, I'm gonna let Jake give you a little bit of information on that one because it's going to be an awesome event. We had one back in March in Jacksonville. All the students came, networking, deal sponsors, deal flow, checking out properties, education, going out to drink at nighttime, networking. It was a lot of fun. I had a great time at that one. And we're having a boot camp June 22nd and 23rd, a buy right boot camp with our master coach, Bill Ham, teaching it. It's going to be another great event for the Jake and Gino students. If you want deal analysis, you want to actually know how to underwrite these deals, market cycles, debt structuring, meeting the Jake and Gino family out there, it's going to be another awesome event. So Stenziano, let's talk about this money mixer. What's the whole impetus behind it?
Education times action equals results. After you get the deal, then what the hell do you do? Okay. You're going to have my mentor who opened my eyes to scaling businesses. Jim Clayton is going to be the keynote speaker for the multifamily money mixer. So you're going to be out there during the day. We're going to be walking units. We're going to be on site. We're going to be talking multifamily. We're going to be building relationships. We're going to be growing the business. And then at night, you're going to hear from an amazing speaker, sold his company to Warren Buffett. And, he just got started in the multifamily business years and years ago. So you're going to have one of the godfathers of multifamily business teaching the ropes. So I think, you should be there. There's limited seats right now. So, G-Dad? Wait, there's more?
Where do you get that information? The Jaybird.
You call Jay Rusi. Josh Rusi. What's his email?
Josh@jakeandgino.com. You hit him up. He'd love to get you set up. These are events for Jake and Gino students, Jake and Gino members. They're really popular. And it's all about building culture. It's all about identifying as a multifamily investor. It's all about the environment that we're creating. That's what people become successful. If you're in that environment and you're identifying as a multifamily investor and you're actually working with other people trying to achieve the same goal as you, we found that really propels you and that really gives you a lot of impetus towards hitting that goal. So that's why we put these events together, and we have a lot of fun. I mean, we have a great time when we're at them.
Totally. Now back to the meat and potatoes. Today's guest is Nick Chapman. Nick is the Community Finance Director at Rand Capital. He helps multifamily investors get the best possible debt for their deals. So without further ado, Nick, welcome to the show.
Thanks so much for having me, guys. I'm real excited to be here today.
So in my opinion, we're in the golden age of financing for multifamily properties for the responsible investor. How do you specifically align yourself with these investors to make sure they are getting the best possible terms for their deals?
Well, really getting an understanding of their strategy for the deals and really getting an understanding on themselves as multifamily investors, again, their strategy. And then it comes down to really seeking out the best financing options for them and really pitting lenders against each other to make sure that we have the best terms, rates, structure, everything available for these investors.
So if you went to a normal bank, you're going to get whatever terms that bank gives you, and that's it. So you're saying you're shopping multiple options to make sure folks are landing the best possible debt for their deals.
Absolutely. I have my favorite lenders that I love working with, but you got to keep them honest. Woo. Right? You got to keep them honest. And so, and they get it, right? And it's just part of a healthy working relationship. But, I'm here to serve the buyers, right? The borrowers first and foremost, and because I want to have strong working relationships for many years to come.
So, Nick, what do you like about the mortgage business? What gets you up in the morning saying, I want to do this. I want to help people out?
Problem solving and numbers really wind my clock. Like, that's what I love. I love bringing people together, really putting together the pieces of the puzzle to help us get across the finish line the most effective way possible. But it comes down to just problem solving and numbers. Those are my two favorite things in the world.
So what do you see students stumbling with? What are the problems that they come up with you? Like, where do you even start the process? When should they come and talk to Nick Chapman about a deal?
Well, I love to just meet investors, as they're on their journey, whether they're just starting or they've been doing this for many years, just to get to know them so they can get to know me. And what I always say is, let's build the trust, right? Let's just start with a conversation and get to know each other. And then, really for the, investors in our mentorship program, right? They have their coaches analyzing their deals. They have you looking at their deals, giving them the green light or telling them what they've missed. Really the most effective way after we've gotten to know each other to really start talking about your deal is after your LOI has been accepted, and we can really start talking about some strategies as far as the financing. But again, I'm always happy to look at someone's deal as well and give them some guidance on pricing before they even walk the property, so they'll know what to expect and what they may run into on a certain type of property.
So Nick, what do you see are some of students' biggest questions when they first start out?
Really, a lot of the biggest questions, a lot of people getting into multifamily is really just not knowing what the requirements are to get approved for financing. And there's so many nuances as far as guidelines with Fannie and Freddie and so on and so forth. But so it's really just, understanding where they need to be to take down a property, whether, net worth, liquidity, ownership experience, so on and so forth. And the reality is the first three questions that any lender is going to ask you is the property stabilized? What's your net worth and liquidity? And what's your experience? And so what I really love to do is get an understanding of the investor. And if we're short in one of those areas, helping introduce them to another investor that would complement where they're lacking to help them get across the finish line.
I like that. So if I'm going out and I'm going to look for mortgage brokers, what qualities do I look for in a Nick Chapman? What am I looking for as a student?
Really just knowledge of markets, knowledge of what's going on with Fannie and Freddie. Things are always changing. It's not like they post updates on their websites, right? Emails go out to from capital markets to lenders. I stay active with my lenders on a daily basis to know what's happening in certain markets, so on and so forth. And really what I would look for, I just had this conversation with an investor who's been doing this over 20 years. He sent me his underwriting, and I caught a lot of mistakes, right? And it's you have to be very delicate in your response and pointing out where they fell short in their underwriting. And I knew he was working with another mortgage broker, and he's like, the other mortgage broker, I've known him a long time. He's kind of guilting me into working with him. And I said, great, show him your underwriting. And if he doesn't pick up on these mistakes, then I would be very careful about moving forward working with him. If a mortgage broker doesn't have an understanding of underwriting, you could be walking into some dangerous waters.
So when I come to you, what documents, what do I need to have myself? I want to be professional. I want to work with you, but I don't want to look like a newbie investor. What do I need to bring? What do I need to be prepared to come and start working with you?
Well, I came to the Jake and Gino community to work with newbie investors, right? People coming into the program. So it's a safe place with me, right? I'm not going to posture up on you as maybe mortgage brokers that have been doing this for as many years as I have, but just don't have any time or patience for new investors. But what I need to know to really get pricing on a deal and to help you the best, most effectively is obviously an OM, right? The offering memorandum, the rent roll, the T12, and up front, I don't need your personal financial statement and net worth and ownership experience, but I need you to have an understanding so you can just tell me over the phone, right? And then we can discuss, hey, listen, you may or may not qualify for this financing, but I have other investors that are always looking to partner with deal finders. So, here's who I can introduce you to, and we'll see if this is a good fit. Or, hey, you're in a great position to take this deal down by yourself. If you'd like partners, I'm happy to make those introductions, but it's up to you.
So give me a highlight view. What is the big difference between residential and commercial lending?
Wow, it's night and day, right?
You sound like you sound like a student. You sound like you're just going to get your first mortgage there.
Well,
I felt the pain in that one.
Gino, it's a great question because so many people have had experience in the residential side, but they may be getting to their first multifamily deals. I think that's fantastic.
There's a lot of things so when you get into bigger deals, when you're working with Fannie and Freddie, there's a lot more gray area. It's very less robotic, right? The underwriters are able to make decisions and come up with solutions. So I work actually directly with underwriters at the lenders, so we can come up with solutions if a piece doesn't fit. When you're dealing with residential, there's a lot more black and white. There's a lot stricter guidelines, and your broker, your mortgage broker, your lender is never going to be able to, work with the underwriter to come up with a solution. It's just going to be, here's the red light, unless you can produce X or a document or what have you. There's just a lot more flexibility. And for example, the biggest difference that I've noticed is residential guys coming into, Fannie and Freddie is the first thing they're shocked at is we don't need your tax returns. Right. It's just really, I just need your personal financial statement, your schedule of real estate owned, and the details of the deal, and we get started.
That's
right?
awesome.
It's more about, okay, so the simple answer is it's more about the property as opposed to the borrower.
Boom. And it was funny because we were literally talking about this yesterday, is that when you see, or, community bank dealings, I think first and foremost, they're looking at the borrower because they want to make sure that they have the liquidity. If the deal fails, that they can swipe a check to basically rescue it, or they can come after them and get the money because it's going to be a recourse deal. On the non-recourse side, they need to be damn sure that their underwriting is spot on and that deal is going to scratch, because then, the next level is going to be bad boy carve outs. Was there something unethical going on in the property? So it's a great point that you just made there. It's fantastic.
Absolutely.
So Nick, what else as far as commercial, residential, term, balloon payments, amortization, interest only, any other high view, elements?
Well, it really is just simply better rates and terms. Now you're going to be looking at lower rates compared to bank financing when you're dealing with Freddie and Fannie. You're going to be dealing with non-recourse, right, as opposed to full recourse, meaning if something goes sideways with the property and you go into foreclosure with Fannie or Freddie, they're not coming after your personal assets. And of course, you won't be able to work with Fannie and Freddie again until you get that straightened out. But that's the one catch there. But as far as amortization, you're going to be looking at 30 years compared to 20 or 25 with a local bank. And, just more IO options as far as your prepayment structure, just a lot more flexibility, and, just all around better rates and terms, and better returns for your investors if you're syndicating, and so on and so forth.
It was funny because when we moved a lot of our assets from community bank financing to the agencies, it was like a freaking party. I mean, you're getting it off your balance sheets. You're getting out to 30 years. They're giving you the interest only. It was like amazing. It was this euphoric feeling that, oh my God, we finally got there. And the terms, just you really feel it in your monthly draws, because you are taking home more of the cash flow than giving it away to the community bank. So it's phenomenal.
Absolutely.
So, I mean, as far as that, how else do you educate investors? Because I know you threw out a term IO. A lot of students don't know what IO means. It's interest only. How are other ways that you create value for the students as far as educating, as far as walking them through the process? What else do we do?
Right. So it goes back to building the trust and giving them a safe place to ask questions, and not making them feel the need to be experts when they get on the phone with me. Mm-hmm. Right. So I always say, hey, listen, stop me at any moment if you have any questions about any of the terminology or options that we could pursue, so on and so forth. But it's really just about creating the trust and giving newer investors a safe place to ask questions and just be comfortable with the conversation and who they're working with. And I think that's a huge difference from a lot of investors' experience.
Jake and we did start off with community, and I mean, can you speak about that a little bit? I think that the community bank is just a tool in the toolbox, right? I mean, there's nothing wrong with community bank. You can't go to agency unless it's $1 million plus with the loan value. So do you have anything else I guess the discrepancies or differences between community and Fannie and Freddie you want to dive into?
I agree. I think community banks are a great tool getting started, right? If your deal is not going to qualify for Fannie or Freddie. I think it's a great tool in the toolbox, and then you can always refinance into agency a couple of years down the road.
Mm-hmm.
So it's almost like a great starter kit, so to speak. But anytime that I can help a buyer get into agency debt as opposed to bank financing, I'm certainly going to give that guidance. I was just illustrating the difference with an investor a couple of weeks ago, comparing it was about a $3 million loan, and even if the rates were equal, going with a 30-year AM compared to a 25-year AM at their bank was going to save their investors $80,000 over the course of 60 months.
Mm-hmm.
So the power of agency financing is just really strong tool. But again, there's nothing wrong with getting started with a community bank. Get started where you can, and then you can always refi into agency debt down the road. What
have you seen the differences or changes in the mortgage industry over the last, I guess, couple of years?
Well, a few changes. One would be, syndications are a hot topic, right? And I think about almost 90% of all acquisitions right now are syndications. And
Wow.
I think it was like a little bit more of the Wild West a couple of years ago, right? Syndicators had a lot more flexibility, didn't have to contribute to the deal. And so Fannie and Freddie have somewhat tightened up on that, making sure that syndicators have skin in the game, and just making sure that their investment is protected, which also benefits the investors in their deal. So just a little bit more on the syndication side is just really making sure that the people syndicating the deal do have skin in the game, do have experience, and are going to protect their investment.
And where have you seen rates gone? Where do you think they're going? I mean, that's a hot topic for everybody. We see when rates really take a tick up, a lot of deals fall out of contract. So, I mean, I know you don't have a crystal ball, but where have rates gone? Where do you think they're going to be going towards?
Wow. It's easy to say that rates are going to go up by the end of the year or next year. We're all expecting that to happen. I woke up this morning and checked a 10-year treasury, and it was down a few bips from last week. And so it's, if you look at it.
I think Gino's trying to talk trade war right now. What's the trade war going to do, huh?
Yeah, right.
They're selling the bonds, so is that gonna drive rates, or is this thing going to keep plummeting? I don't know.
Well, I can share this with you, right? So what's happening with Fannie and Freddie, and this might be an indicator, obviously, they don't share this information directly. Maybe it's speculation, but what we're seeing is what's counterintuitive is they're giving incentives for taking longer terms. So the rates are actually lower on a 10-year term than they are on a 5-year term right now for a lot of deals. And so Fannie and Freddie are really incentivizing buyers for longer holds. So if we speculate on what that means, maybe it means Fannie and Freddie are expecting a downturn, and just encouraging longer holds and not knowing what the next 5 years will tell us or what will happen then. So we're doing a lot of 10 and 12-year deals.
That sparked a question for me, because I know when we started doing Fannie and Freddie, I never knew how to describe what yield maintenance was. Let's talk about the yield maintenance, prepayment penalties, because they're not as big on community banks. They're a lot smaller, but they can be very prohibitive on Fannie and Freddie. And worrying about your basic exit strategy, are you going to refi this thing? Are you going to sell it? Or what the thing is? So let's really hit on what yield maintenance is and what step down.
Yeah, step down versus yield maintenance.
Yes.
Sure. So if we talk about yield maintenance first, right? So and Fannie and Freddie both offer yield maintenance, but it's just the option that Fannie only offers. And essentially it's, they want their interest that's expected throughout the term of the loan, no matter what.
Yep.
Right. That means if you have a 12-year term, they want 12 years of their interest.
It sounds like the government, bro. They want their piece of the action no matter what, dude. You're paying me one way or the other, right?
Student loan debt, man. You get whacked. No exit in that shit.
Nick, sorry to cut you off, but that just that's that.
Quasi there.
The biggest mafia out there, right? And so, but part of it is this: they're protecting their investors, and they want their investors to keep pumping money, so they can keep lending it. So if with the rates being so low, the investors' returns wouldn't be very attractive if you took a 12-year term and Fannie was expecting X amount of interest on that deal, and then you refinance after 2 years and they miss out on 10 years of interest. Their investors would be shorted their expected returns. So that being said, you really have to have a clear strategy, like you said, Jake, the exit strategy, so we can really structure the term length that's appropriate to match that. But there's wiggle room, right? So we did this for that deal in Elements, right, in Louisville, where it was a 12-year note, but we were able to reduce the yield maintenance to 9 years, right? And so
6 years IO too.
6 years of IO too. But we were able to reduce the yield maintenance. I'm doing that on another deal as well. On a 12-year deal, we're reducing the yield maintenance to 9 years. And, it's a really powerful tool and something to use. As far as step down, it's a more attractive prepayment penalty structure. So with Freddie, right, you can choose yield maintenance or step down. Step down is an extra 20 bips on the rate, 20 basis points. And the reason is it's a more flexible, more cost-effective prepayment penalty on the deal. So just to give you some, for people that are new and listening, on a 5-year note, the step down would be 5, 4, 3, 2, 1, meaning if you were to sell or refinance in year 1, you'd have a 5% prepayment on the loan balance. Year 2, you'd have a 4% prepayment penalty on the loan balance, and so on and so forth until you get to year 5, and it's a 1% prepayment penalty on the loan balance, and then the last 6 months of the term, the prepayment penalty is waived.
Differences. Can you give us a couple differences between Freddie and Fannie?
Absolutely. Freddie is definitely more friendly towards newer investors, as long as you're meeting net worth and liquidity requirements. Fannie definitely prefers more experienced investors. And typically with Fannie, you will get lower rates in most cases, because of that, but it's pretty close. And in some markets, it's the difference is negligible. And so sometimes Freddie is just a better way to go. Both Freddie and Fannie, they don't have the same appetite for the same markets all over the country. So it's really deal specific, but that's why I love to pit them against each other on every deal as well.
Mr. Stenziano, what else you got here? I mean, there's so many things with this. What stuck points did we have? I'm trying to think back on our journey as far as the financing. We didn't know what the hell we were doing.
Limiting beliefs. It was like, we just, because it's like this. When you're 18 and you have no credit and you want to go buy a car, you don't have credit to get the loan for the car. So what the hell do you do? And that was a limiting belief that we had. Oh, we can only do community banks. We can't qualify for the agencies because we didn't have the right advisors on our team, and people were coming and showing us these agency deals, but they were trying to take too much and their rates were too high, and it was like we just struggled to get into agencies in the beginning. It took us way longer than it should have because we didn't have the right people on our team advising us. And that's why the way I really look at the mortgage broker role and the way we look at Nick is really an advisor and a coach. Because a minute ago he was talking about understanding underwriting, and this is one key for everyone to know out there, is that you can put your deal in front of a mortgage broker. They can give you, this is what the terms are going to be, but then if they don't underwrite it properly, you can get down the road and all of a sudden the terms are going to change and this, that, and the other thing. So it happens at times, but the more sound the mortgage broker is with the underwriting in the front end, the more consistent when you start the deal, hey, these are the terms, that those will be the terms when you close the deal. Because we've gotten into deals in the past where, hey, it's going to be 3 years interest only, and this is going to be the rate. And then you get close to rate lock, and it's like, nope, 1 year interest only, and your LTV just shot up. That blows up a lot of shit, and that can really mess with you. That's why having a sound advisor on your team is the most important piece. With that being said, let's take a quick time out here from our sponsor. Gino, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. I know that you've been hard at work helping Jake and Gino students do just that using our framework. Can you explain to the listeners how they can get our help?
Guys, we've been hard at work growing our community of like-minded investors, and the results of our members has been nothing short of incredible. We're looking to grow this amazing group. What we're looking for is those who want to follow our proprietary framework that we've created: buy right, manage right, and finance experience right. Leverage our connections, education, and mentorship as ways to take your business to the next level.
So if you're interested in finding out more about how you can become a part of our amazing community, apply to work with us at jakeandgino.com/apply. All right, and we are back. Nick, you said something earlier that was really interesting. You said you like to keep your lenders honest. Talk about that a little bit, because I have my own answer for that, but I want to hear what you're about to say.
We all wake up and do this no matter to make money, right? We all have families to feed and bills to pay. And if you get really comfortable and have a great relationship with one lender, odds are they know you're going to come back. They know you're going to bring them deals, and they might creep in and keep pushing in their premium into their rates, and you're just going to trust it. Right. But however, they have managers that are pushing them to put more premium in their deals and so on and so forth. And so the way that you keep everyone honest and fair pricing is, hey, Bob, I love working with you. I've sent you 6 deals in the past, 4 weeks. I double checked with another lender on this deal, and their rate was 35 bips lower. Talk to me about this. And a lot of times they'll sheepishly say, hey, Nick, no problem. Let me sharpen the pencil. Let me take this to underwriting. And really they'll just, take their premium out and come back with the right rate. And so it's nothing sinister or anything
business.
like that. It's just business. And they get it.
I don't know what it is, but I don't care if it's community bank, an agency, whatever the hell it is. If you're lending money, the common thread, the common theme that I've seen from the beginning is that if you show any of these folks a term sheet from a competitor that's better than theirs, that will move the needle quicker than anything else.
They pucker up. Is that what you're saying?
Yeah, you got to do your homework though, and you got to put the work in to get those other quotes. And that's why working with a mortgage broker takes that much off your plate, because that's the work that they're doing, and it moves the needle time and time again. Especially in the beginning, when we were starting out with those community banks, when we first started working with agencies, you have to get quotes from competitors. And I'll even have guys, if I'm pushing them, back when we started saying, well, do you have something else from another, bank or whatever? And they were literally giving me the roadmap. You have to do the work though. And so, that's a key to it. And it's just something I've seen from the beginning. I think it holds true till today. What about tips? You mentioned, especially getting in your first few deals, the amount of paperwork and organization that it takes for folks. Can you just talk about maybe a few tips and what that process looks like, and some of the documents that are coming over? So if someone's going to be doing their first deal with, Freddie Mac SBL, just maybe 1 or 2 pointers on how to get ramped up and organized for that.
The paperwork's coming.
Woo!
It's coming.
Winter's coming. The agency paperwork is coming. I knew it. Oh, we had to get a.
You brought it up. Gino was pushing earlier about the differences, and I was dodging that bullet, right? Because if you're used to working with a community bank, there's going to be less paperwork. Yeah, you'll have to do more.
Because it's recourse, and they're coming for you.
Yeah, but Fannie and Freddie, it's non-recourse. So there's going to be a lot of paperwork. A lot of it's going to be redundant, but it's coming. And so what I try to do is make it easy. But what I ask is, let's get this done. Let's be responsive. And, I'll push you here and there, but, we're all adults, and it's on you to get it done. Yep. Right? That's the bottom line. And when you wait and delay, that's when there's surprises. And that's what happens, right? And it's not always the borrower's fault or whatever. Sometimes maybe a seller's hiding something, right? Financials or what have you that might change the terms of the deal. But the paperwork's coming. And it's going to be about you and the borrowing entity and the property. And I'll be sending you stuff to send to the broker, for the broker and the seller to complete. I'll be sending you a ton of paperwork for you to complete on behalf of yourself and the borrowing entity. And, I just try to keep it pretty organized for you and not overwhelmed. Just get the most important things in quickly. And then just try to just make it as easy on you as I can. But as everyone who's done an agency loan knows, it's a lot of paperwork.
So I'm going to quote the wise words of my Little League baseball coach, Mac, Mr. McDonald. get them early, get them often, hum now, kid. Okay. So at the end of the day, you got to get your docs in early, get them in often, because like you said, they're coming, and that's going to make for the smoothest transition. Look, you're getting premium financing. You are getting the best of the best. So you need to be able to get your stuff in, be responsible, and make it happen there. So completely agree with that. What about a mistake that you see, and this maybe dovetail right into the previous question, but a mistake that you see folks making on their first deals, or especially starting out? What is a common mistake that you see starting out?
Gosh, it really comes down to underwriting. Gino talks about this better than anybody, right? Never fall in love with a property. Right. It might look good, and then the financials come in, and you just have a case of the gotta have it. And so that's one thing I do when I look at your underwriting is I look at it from a lender perspective, but also from an investor perspective. Right. And I think that's something unique value that we bring here from the Jake and Gino team. But I really think that Chris Voss, who was on the podcast, he said it best. We're always looking for proof of life in a deal. Right. And a lot of deals aren't meant to be, but we're just hoping that it works out. But you really have to be, really deep in the numbers and have a clear strategy, as opposed to, I want to buy this apartment building. I think it'll work.
Patient, persistent, but willing to walk away. Because it's what does the G-Dad say? No deal is better than a bad deal.
That's right, my friend. I have one question that just popped up, and I get this a lot from students. When we did a community deal, the last one we did, I was amazed at how small the closing costs were. It was a really cheap loan to do. Origination fee was cheap. The pay appraisal. I mean, it was just so much cheaper. Can you give us an idea, ballpark? I know we hate doing rules of thumb, but what should people expect on closing costs and fees?
3% of the purchase price, right, is a great rule of thumb. It's conservative. I mean, I know there's people with investors that underwrite 4 or 5% when they're doing 300 or 400 or plus unit deals. But 3% is a really safe place to be as far as closing costs. And, some lenders will not roll up any of the closing costs into the deal, and some will if there's room. So it's another option and thing to consider. Typically for a lot of deals I do, when there's plenty of room in the deal, we're able to roll up the closing costs up to 3% of verified closing costs into the loan. So that's been a really powerful tool for a lot of investors that I work with to really lower their out-of-pocket expenses.
Nice. Any book recommendations? Anything you've read recently, or any classics that you want to share with the listeners?
We talk about Atlas Shrugged, right? But I love The Fountainhead. That's Howard Rourke.
The architect.
I love that book. If you haven't read it, if you're a fan of Atlas Shrugged, I think you should read it. Right now,
excellent. This is big stuff here. We got to get the G-Dad through Atlas Shrugged first. You just teed him up with another one.
Dude, you're killing me.
Dude, the Chappie's outpacing you, bro. You're the voracious reader. You got to step it up, man. Come on, man.
Black Swan. That's just an interesting read. And Talent Code, based on
Daniel Coyle, boy, that's a great book.
Yeah,
dude.
From the podcast recommendation here a little while ago, and so I'm just cracking into that. But those would be the three that I've got going on right now. Well, Fountainhead I read a long time ago. I've reread it a couple times, but right now I'm just getting through Black Swan and Talent Code.
What's the easiest way for listeners to get a hold of you?
Nick at randscapllc.com. You can also go to our website, randscapllc.com, and there's my contact information is there. And you can also just click on the bar to start the conversation, and that'll send me an inquiry, and I'll get right back out to you. I'm in the Jake and Gino community Facebook group, so you can always reach out to me that way. Any way you feel comfortable reaching out, I'm always here for you.
So if you want to partner with the professional that we partner with, Nick's your guy. G-Dad, take us home.
Couple of things, Jake. I think the mortgage broker is an important team member. I think you need to start looking at a mortgage broker when you're getting serious and you're looking at deals. You don't want to wear the mortgage broker out. You just don't want to start sending him deals and make him look at deals and just constantly wearing him out and just using him as your underwriting. That's not what he's there for. What you can do is say, Nick, what do you think expenses are in this market? Does this look okay? But don't constantly keep sending him deals because they get paid by closing deals. They don't get paid by doing a lot of work. Obviously, a good mortgage broker will help you out, but you can't wear them out. I think don't be overwhelmed by the fact that residential is different than commercial because they are different. But I think commercial in one aspect is pretty cool. I mean, you're basically looking at the deal. You're not looking at the person. Create that relationship. And like you said, Jake, no deal is better than a bad deal.
Hey, it all goes back to the framework. Buy right, manage right, and finance right. And when you're going through the buy right, you're going through the finance right at the same time. So you focus on your underwriting, get the deal teed up, get it over to your mortgage broker. And then, from there, you're on to your management portion. So great job. Appreciate everybody's time today.
Thanks for having me,
Thanks,
guys.
Nick. Have a great week, guys.